Friends, thank you for being here today. What if I told you that Canada's third largest bank just placed $1 billion bet against you, not against the market, not against some abstract economic indicator, against you, the Canadian borrower, the homeowner, the person trying to hold it together with a mortgage and a credit card balance? In the fourth quarter of 2025, Scotiabank did something that should make every Canadian stop and pay attention. They took $1.11 billion, money that could have gone to shareholders, money that could have boosted their stock price, money that could have lined executive pockets, and they locked it away in what the financial industry calls a provision for credit losses. That's banker speak for a bunker filled with cash, waiting for you to fail. Let me be clear about what this number represents. This is not a precautionary measure. This is not conservative accounting. $1.11 billion is a war chest built specifically for an anticipated wave of defaults, delinquencies, and financial collapse at the household level. They are not betting on your success. They are betting on your failure, and they are willing to sacrifice nearly 10% of their domestic banking profits to prepare for it. Now, you might be thinking, banks are always conservative. They always hold reserves. This is standard practice, and you would be wrong, because what makes this different, what makes this a screaming warning siren that most Canadians will sleep through, is the timing and the scale. While every politician, every central banker, every talking head on the financial networks is telling you that the consumer is strong, that Canada avoided recession, that we've achieved some mythical soft landing, Scotiabank's balance sheet is telling you the exact opposite story. This is a mathematical reality that cannot be spun. When a major financial institution takes $1 billion and essentially writes it off before the loans even default, they are reading data that you and I don't have access to. They are seeing something in their internal algorithms, in their portfolio analytics, in the repayment patterns of millions of Canadians that terrifies them enough to take an immediate profit hit. And here's the part that should keep you awake tonight. They sacrificed those profits willingly. Scotiabank's Canadian banking division saw earnings drop 9% year over year. 9% in a single year. That's roughly $340 million in earnings that evaporated, not because of competition, not because of innovation, but because they chose to hoard cash for the storm they see coming in 2026. We are looking at a convergence of financial forces that the average Canadian has never experienced in their lifetime. The provision for credit loss is not just a number on a spreadsheet. It is a confession. It is the bank admitting, in the only language that matters to them, that they expect a significant portion of their loan portfolio to go bad. And when I say go bad, I mean people losing homes, defaulting on car loans, maxing out credit cards, and then disappearing into bankruptcy. But here's what makes this even more chilling. This isn't just Scotiabank. This is a sector-wide phenomenon. BMO reported $755 million in credit loss provisions in the same quarter. Royal Bank's impaired loan ratio climbed to 39 basis points, up from 35. The entire Canadian banking cartel, the Big Six that control nearly everything, is simultaneously tightening their belts, cutting costs, and hoarding cash. This is the financial equivalent of watching every smart person in the room quietly move toward the exits. They're not running, they're not panicking, but they are positioning themselves for something that the rest of the crowd hasn't noticed yet. Now, let me take you back to understand how we arrived at this moment, because this crisis didn't begin in the fourth quarter of 2025. This has been building for years, hidden beneath the surface of historically low interest rates and what I call the great monetary illusion, the belief that free money could last forever. Think back to 2020 and 2021. The Bank of Canada, in response to the pandemic, dropped interest rates to near zero. The overnight rate hit 25 basis points. Mortgages were available at rates that Canadians had never seen before: 1.5%, 1.8% fixed for 5 years. It felt like a gift. People rushed into the housing market, convinced that they had discovered some kind of financial cheat code. But here's what nobody told them, what the banks understood but didn't advertise. Those rates were not a gift, they were a trap with a timer set for exactly 5 years. See, the majority of Canadian mortgages are structured with a 5 year term. You sign at a low rate, you celebrate, you plan your life around that monthly payment. But in year 5, you have to renew. You have to go back to the bank and negotiate a new rate based on current market conditions. And in 2026, right now as we speak, the bulk of those pandemic era mortgages are hitting their renewal date. Except now, the Bank of Canada's overnight rate sits at 3.25%. Mortgage rates are hovering in the 4.5 to 5.5% range. That means a homeowner who locked in at 1.6% in 2021 is now facing a mortgage payment that could be 60, 70, even 80% higher. On a $500,000 mortgage, that's the difference between $2,100 a month and $3,600 a month. Can you absorb a $1,500 monthly increase in your housing costs? Can your neighbor, can the family 3 doors down who just bought at the peak of the market in 2022? Scotiabank knows the answer, and that answer is why they just stockpiled $1.11 billion. This leads us to the system's most crucial secret, which we will explore later: the difference between nominal wealth and functional liquidity. But before we get there, you need to understand the architecture of what's happening, the structure that is now showing its first major fault lines. The Canadian banking system operates on a simple premise: they lend you money at a higher rate than they borrow it. The spread, the difference between what they pay for funds and what they charge you, is their profit. But when the central bank raises rates rapidly, as they did from 2022 to 2024, something breaks in that machinery. First, the net interest margin compresses. Banks are suddenly paying more for deposits while older loans are still locked in at lower rates. Second, the quality of their loan book deteriorates. People who could afford payments at 2% suddenly can't afford them at 5%. Third, and this is critical, the entire economy slows down because money becomes expensive. Businesses stop investing, consumers stop spending, unemployment starts to creep upward. And that's exactly what Scotiabank's Chief Risk Officer, Phil Thomas, acknowledged in their earnings call. He stated explicitly, "We continue to operate in what remains a highly uncertain macroeconomic environment." That's corporate speak. Let me translate it for you. We have no idea how bad this is going to get, but we're scared enough to prepare for the worst. The specific drivers he cited were revealing. Mortgage delinquencies are rising, particularly in the Greater Toronto Area, the heart of Canada's housing bubble. Unemployment is elevated and sticky, meaning people who lose jobs aren't finding new ones quickly. And perhaps most telling, trade uncertainty with the United States is freezing business investment. Companies are not hiring, they're not expanding. They're waiting to see if the ground beneath them is solid or sand. Now, here's where it gets personal. While Scotiabank was hoarding that $1 billion, They were also taking a $373 million restructuring charge. That's the polite term for mass layoffs. They cut approximately 2,300 employees year over year. Think about that. The bank is simultaneously preparing for customer defaults and firing its own workers. This is what I call a defensive posture. It's what institutions do when they're not worried about missing out on growth. They're worried about surviving a contraction. You don't cut staff and hoard cash when you expect a boom. You do it when you expect a bust. And CEO Scott Thompson, in that uniquely bloodless corporate language, called it simplifying Canadian operations. Simplifying, as if complexity was the problem and not the fact that Canadian household debt to income ratios are at 180%, meaning the average Canadian owes $1.8 for every dollar they earn in a year. So let's talk about what happens when this isn't just one bank's problem. Let's talk about contagion. Because here's the uncomfortable truth that nobody in the financial media wants to acknowledge. Scotiabank is not an outlier. They are not being paranoid. They are not overreacting. They are simply the most visible symptom of a systemic disease that's spreading through the entire Canadian banking sector. BMO, the Bank of Montreal, one of Canada's oldest and most conservative institutions, reported $755 million in credit loss provisions in the same quarter. Now, that's down from their spike last year, which tells you they already started building their bunker earlier. They saw this coming before Scotiabank did. But here's what matters, that 755 million is still sitting there, still weighing down their earnings, still representing money they expect to never see again. Royal Bank, the largest bank in Canada, saw their impaired loan ratio climb to 39 basis points from 35. Now, for those of you who don't speak banker, let me translate what a basis point means in the real world. 1 basis point is 1/100th of a percent. It sounds tiny. It sounds like statistical noise. But when you're talking about a loan portfolio worth hundreds of billions of dollars, those 4 basis points represent tens of millions of dollars in expected losses. And here's the pattern that should terrify you. Every single one of the big six banks is moving in the same direction simultaneously. TD, RBC, Scotiabank, BMO, CIBC, National Bank, they're all tightening, all provisioning, all cutting costs. This is not competition. This is coordination born of shared terror. Think of it like this. Imagine you're at a party in a high-rise building. Everything seems fine. The music's playing, people are laughing, drinks are flowing, but then you notice something. The fire marshal leaves, then the building engineer, then the security chief. They're not running, they're not shouting, they're just quietly moving toward the stairwells. Would you stay at that party, or would you ask yourself what they know that you don't? The Canadian banks are the fire marshals, and they're moving toward the exits. Now let me show you the canary in the coal mine. Because this isn't just about mortgages and credit cards. This is about the entire architecture of consumer credit starting to snap at its weakest points. Scotiabank's chief risk officer specifically mentioned that delinquencies are rising in the Greater Toronto Area, the GTA, the heart of the Canadian housing bubble, the place where detached homes were selling for $2 million in 2022, where condos were getting bidding wars, where the phrase priced out forever became common vocabulary for an entire generation. Those buyers from 2021 and 2022, the ones who stretched themselves to the absolute limit, who used every dollar of borrowing capacity, who convinced themselves that housing only goes up, they are now facing renewal, and the math doesn't work anymore. Let me give you a specific example, not theoretical, but real. A couple buys a house in Mississauga in early 2021 for $800,000. They put down the minimum, 5%, which is 40,000. They finance 760,000 at 1.69% for 5 years. Their monthly payment is about $3,200, tight but manageable with two incomes. Fast forward to 2026, renewal time. The rate is now 4.79%. Their payment jumps to $4,400. That's an extra $1,200 a month, $14,400 a year. And here's the killer: their incomes haven't gone up. In fact, with unemployment rising and hours being cut across multiple sectors, they might actually be making less than they were in 2021. What do? They can't sell. The market has softened, and after realtor fees and penalties, they'd walk away with nothing or even owe money. They can't refinance with another bank because their debt to income ratio now disqualifies them. They're trapped. And Scotiabank knows there are thousands, maybe tens of thousands of these couples scattered across their mortgage portfolio. That's what the $1.11 billion is for. It's for them. But it's not just mortgages. Let me tell you about a name you probably haven't heard: Tricolor. It was a subprime auto lender operating in Canada, targeting people with damaged credit who needed a car. They were writing loans at 15, 18, 20% interest, high risk, high reward. And in 2024, they collapsed, not because people suddenly became less creditworthy, but because their credit lines, the liquidity they needed to keep writing loans, froze. The wholesale lending market looked at their portfolio and said, "We're not funding this anymore." That's the early warning system. The subprime lenders fail first. They're the most exposed, the most leveraged, the first to lose access to capital when the credit markets tighten, but they're not the last. They're just the beginning. First brands, Renovo Homes, these are the names that appear in the footnotes of financial news, the companies that go under quietly while everyone is watching the stock market. But they're the forensic evidence. They're proof that the rot has started, that the liquidity tide is going out, and we're about to find out who's been swimming naked. And here's what makes this moment uniquely dangerous. We're not dealing with one crisis. We're dealing with a convergence, a trifecta of forces hitting simultaneously. First, the structural break in mortgage renewals. That's the renewal wall of 2026. It's not a possibility. It's a mathematical certainty. Those mortgages will renew. Those rates will reset. And a statistically significant portion of those borrowers will not be able to afford the new payments. Second, the domestic liquidity crisis. The Bank of Canada has drained hundreds of billions of dollars from the system through quantitative tightening. They printed money during COVID, and now they're burning it. Every month, billions of dollars are simply disappearing from the economy as bonds mature and aren't replaced. This is deflationary. This is contractionary. This is by design. But the people who designed it have never actually lived through what happens when you drain this much liquidity this fast from a debt-saturated economy. Third, the sovereign debt spiral at the federal level. Canada's federal debt has exploded from $600 billion before COVID to now over $1.2 trillion. The interest payments alone are becoming one of the largest line items in the federal budget. And here's the vicious cycle. As rates stay elevated, those interest payments grow. As interest payments grow, the deficit grows. As the deficit grows, they have to issue more bonds. As they issue more bonds, they compete with private borrowers for capital, which keeps rates elevated. It's a feedback loop with no natural exit. These three forces are not separate. They are interconnected, interdependent, and self-reinforcing. The mortgage crisis weakens consumer spending, which weakens the economy. which forces the government to borrow more, which keeps rates high, which makes the mortgage crisis worse. And sitting in the middle of all of this are the Canadian banks, watching their loan portfolios slowly turn from green to yellow to red on their internal dashboards. Now, you might be thinking, but the banks are profitable. Scotiabank still made money. They're fine. And you would be missing the point entirely. Yes, they're profitable today, but they're provisioning for tomorrow. They're taking money off the table now because they don't believe it will be there to take later. This is not about quarterly earnings. This is about survival. This is about making sure that when the default wave crests in late 2026 and early 2027, they have enough capital cushion to absorb the losses without requiring a government bailout. And let's be very clear about what impaired loans actually means in human terms. The banks report them as basis points and ratios, but every basis point represents someone's financial life falling apart. It represents a family losing their home, a retiree losing their condo, a small business owner watching their life's work get seized by creditors. Scotiabank expects their impaired loan ratio to sit in the high 40s to mid 50s basis points for 2026. That means roughly one out of every $200 they've lent out will go bad. That sounds small until you multiply it by their total loan book, over $600 billion. Even at 50 basis points, that's $3 billion in loans that will fail. $3 billion in shattered dreams, broken families, and financial ruin. And here's what the banks won't tell you, what they can't tell you because it would cause panic. They don't actually know how bad it's going to get. The models they use to predict defaults are built on historical data. But we've never had a situation quite like this before. We've never had an entire generation of homeowners renewing mortgages into rates that are triple what they originally locked in at. We've never had household debt this high combined with inflation, this persistent combined with wage growth, this anemic. The banks are essentially flying blind, using instruments calibrated for normal weather while they're heading into a Category 5 hurricane. That's why the provisions are so large. They're not predicting exactly what will happen. They're preparing for a range of possibilities, and the worst case scenarios in that range are catastrophic. So when you see that $1.11 billion, don't think of it as excessive caution. Think of it as the bare minimum they need to survive what's coming. Let me give you one more piece of evidence that shows just how deep this goes. Scotiabank didn't just provision for credit losses, they also took that $373 million restructuring charge. And part of that charge was severance for 2,300 employees they let go. Now, why does a bank fire people right before a crisis? You'd think they'd need more staff to handle the increase in defaults, collections, restructuring, but that's not how it works. They're firing people in anticipation of lower loan volume. They're firing people because they expect fewer customers to qualify for new loans. They're firing people because they're preparing for a smaller, more defensive operation. This is batten down the hatches mode. This is not growth. This is not expansion. This is pure survival instinct kicking in at the institutional level. And the CEO, Scott Thompson, calls it simplification, as if the problem was organizational complexity and not the fact that the Canadian consumer is drowning in debt and about to get hit with a wave of payment shock that they cannot absorb. The euphemisms are almost Orwellian. Simplification means layoffs. Macroeconomic uncertainty means we have no idea what's coming, but it looks bad. Provision for credit losses means we expect you to fail. This is the language of managed decline. This is the vocabulary of institutions preparing for contraction while trying not to spook the herd. So, where does this leave you? Where does this leave the average Canadian who's been told everything is fine, who's been assured that we've achieved a soft landing, who's been promised that the worst is behind us? It leaves you standing at a crossroads. And the choice you make in the next few months will determine whether you're financially intact on the other side of what's coming or whether you become part of that statistical abstraction, one of those basis points that Scotiabank has already written off. But before we talk about action, we need to talk about the enemy. And the enemy is not the banks. The enemy is not the government. The enemy is not even the economic system itself. The enemy is inside your own head. It's called normalcy bias. Normalcy bias is the psychological phenomenon where human beings are hardwired to believe that tomorrow will look like yesterday. It's the reason people don't evacuate before hurricanes. It's the reason investors hold stocks all the way down in a crash. It's the reason homeowners in 2008 thought the housing market would recover next quarter, then next year, then eventually stopped thinking about it at all as they mailed their keys back to the bank. Your brain is designed to seek patterns and assume continuity. For the last 15 years, despite multiple crises, despite pandemic, despite inflation, the Canadian housing market has always recovered. The banks have always been stable. The system has always found a way to muddle through. And so your brain tells you it will happen again. This time will be like last time, except it won't, because the variables have changed. The debt levels are higher than they've ever been. The interest rate shock is more severe than anything in modern Canadian history. The global economic backdrop is more fragile, with trade wars, geopolitical instability, and sovereign debt problems in multiple major economies simultaneously. This is not 2008. This is not even 2020. This is something new, and your normalcy bias is going to get you killed financially if you let it convince you to do nothing. Let me tell you about another psychological trap: the money illusion. This is the belief that because the numbers in your bank account or your investment portfolio are going up, you are getting wealthier. You see your house appraised at a higher value and you feel richer. You see your retirement account hit a new high and you feel secure. But here's the reality: you can become a millionaire on paper and poorer at the grocery store simultaneously. If your house goes from 800,000 to 1 million, but the cost of food, energy, and everything else you actually need to live doubles, are you wealthier? If your investment portfolio grows by 20%, but inflation runs at 15% and your real purchasing power only grows by 5%, have you won? The money illusion is particularly dangerous right now because it creates complacency. People look at their nominal net worth and think they're insulated from crisis. But nominal wealth is not the same as functional liquidity. Nominal wealth is what your assets are theoretically worth if you could sell them tomorrow at today's prices to a willing buyer with available capital. Functional liquidity is what you can actually convert to cash right now in a crisis when everyone else is trying to do the same thing. And here's the secret that Scotiabank understands, but most Canadians don't. In a liquidity crisis, those two numbers diverge catastrophically. Your house might be worth $1 million on paper, but if there are no buyers with mortgage approval and no one has down payments, what is it really worth? Your stock portfolio might show a certain value, but if you try to sell in a panic with everyone else selling, what price will you actually get? This is the difference between assets and claims on assets. And this distinction is about to become very, very important. Scotiabank has assets. They have buildings, they have gold in their vaults, they have real reserves. But what do you have? Most Canadians have claims. You have a number on a screen that represents your equity in a house. You have shares in a mutual fund that represent a claim on a fraction of corporate earnings. You have a balance in a checking account that represents a claim on the bank's liquidity. And when the system comes under stress, the people with actual assets survive. The people with claims on assets are the ones who get wiped out. So let me ask you directly, do you own assets or do you own claims on assets? Do you own something tangible that holds value independent of the financial system's stability? Or do you own paper promises that depend on counterparty solvency? This is not a philosophical question. This is the most practical question you can ask yourself right now. Let me tell you what Scotiabank is doing with their money. They're not keeping it in stocks. They're not keeping it in bonds. They're holding it in the most liquid, most secure form possible, cash and cash equivalents. They're preparing for a world where liquidity is the only thing that matters, where being able to meet your obligations instantly is the difference between survival and failure. Now you might say, but I should hold cash too then. And you'd be half right. Cash is better than illiquid claims on overvalued assets, but cash has a fatal flaw in the current environment. Inflation is eroding it in real time. The official inflation rate might say 3%, but anyone who buys groceries, pays for utilities, or needs to repair anything knows the real number is higher. Your cash is melting like ice in the sun, slowly, invisibly, but constantly. So what's the answer? What's the asset class that maintains liquidity, holds value independent of counterparty risk, and protects against currency debasement? The answer is the same answer it's been for 5,000 years of human civilization: gold and silver. Now, before you roll your eyes and think this is some kind of doomsday prepper fantasy, let me be very clear about what I'm saying and what I'm not saying. I'm not saying gold is a get-rich-quick scheme. I'm not saying you should sell everything and buy gold coins. I'm not saying the dollar is going to zero tomorrow or that we're going back to a gold standard. What I am saying is this: gold is not an investment. Gold is insurance. It is a way to step out of the line of fire. It is a way to hold wealth in a form that doesn't depend on a bank's solvency, a government's fiscal responsibility, or a central bank's policy decisions. When Scotiabank provisions $1.11 billion for defaults, they're protecting themselves against your failure. What are you doing to protect yourself against their failure, against the system's failure? Gold is the asset you hold when you no longer trust the claims. It's the asset you hold when you realize that the entire architecture of debt-based fiat currency is built on a foundation of confidence, and that confidence is starting to crack. Look at what the central banks are doing. Not what they're saying, what they're doing. Central banks around the world have been net buyers of gold for over a decade. China, Russia, India, Turkey, Poland, they're all accumulating physical gold. Why? Because they understand that in a multipolar world with increasing debt, increasing tension, and decreasing trust, gold is the ultimate settlement asset. If it's good enough for the People's Bank of China, if it's good enough for the European Central Bank, why isn't it good enough for you? The binary choice is this: do you hold your wealth in the form of claims that depend on the system's stability, or do you hold it in assets that exist independent of the system? Do you hold ETFs and mutual funds that give you a fraction of a claim on corporate earnings, or do you hold physical metal that you can store in your own possession? I know what the financial advisors will tell you. They'll tell you that gold doesn't pay dividends, that it doesn't generate cash flow, that it just sits there. And they're right. Gold does just sit there. That's the point. It sits there and maintains its value while paper burns. Silver is even more interesting because it has dual properties. It's a monetary metal and an industrial metal. The world needs silver for solar panels, for electronics, for electric vehicles. The supply is tight. The above-ground stockpiles are declining, and yet silver is trading at a fraction of its inflation-adjusted historical highs. But here's what matters more than price: accessibility. You can still buy physical silver in Canada right now. You can walk into a dealer and walk out with 100 ounces. That might not be true in 6 months. That might not be true when everyone else wakes up to what the banks already know. The window for preparation is closing. Not tomorrow, not next week, but it is closing. And the thing about windows is that you don't know exactly when they'll shut until they're already shut and you're on the wrong side. Scotiabank knows this. That's why they acted in Q4 2025. They didn't wait for confirmation. They didn't wait for the defaults to actually materialize. They saw the data, they ran the models, and they spent $340 million in lost profits to build their shield before the arrows started flying. You have the same opportunity. You have the same choice. You can act on imperfect information and be early, or you can wait for perfect information and be late. Let me tell you what late looks like. Late looks like trying to sell your house in a market with no buyers. Late looks like calling your bank for a line of credit and being told they've frozen new lending. Late looks like watching your investment portfolio drop 30% in a month while every financial advisor tells you to stay the course and think long term. Late looks like being one of those basis points that Scotiabank already wrote off. Early looks different. Early looks like sacrifice now for security later. Early looks like converting some of your paper claims into tangible assets while the conversion is still possible. Early looks like being the person who prepared while everyone else laughed and surviving while everyone else scrambles. History favors the prepared. It rewards the people who see the structural fault lines before they rupture. It rewards the people who understand that when the smart money is building bunkers, the dumb money should probably stop buying lottery tickets. The banks have made their choice. They've looked at the data, the same data they carefully avoid sharing with you in plain language, and they've decided that defense is more important than growth. They've decided that survival is more important than profits. What choice are you going to make? Because here's the final truth, the one that nobody wants to say out loud. The system is not designed to protect you. The banks will survive. They have government backstops. They have deposit insurance. They have the implicit guarantee of being too big to fail. But you have what you've managed to save, and you have the decisions you make right now. Scotiabank will be fine. They've got their $1.11 billion shield. They've cut their costs. They've positioned themselves defensively. When the mortgage defaults hit in 2026, when the credit card charge-offs spike, when the auto loans go delinquent, they'll absorb the losses. Their stock might drop, their bonuses might shrink, but the institution will survive. The question is, will you? And I don't mean physically, I mean financially. Will your standard of living survive? Will your retirement plan survive? Will your ability to provide for your family survive? Those questions get answered not by what you hope will happen, but by what you do right now, today, with the information you have. The curse of 2026 is not a prediction, it's an inevitability. Those mortgages will renew, those rates will reset, those payments will increase, and a certain percentage of Canadians will not be able to afford them. The only question is whether you'll be in that percentage or not. So here's my final word to you, friends. I'm not asking you to panic. I'm not asking you to liquidate everything and move to a bunker in the woods. I'm asking you to look at what the institutions with the most information are actually doing, not what they're saying, and to ask yourself if you should be doing something similar. I'm asking you to audit your own balance sheet with the same cold honesty that Scotiabank's risk committee used when they decided to hoard $1 billion. I'm asking you to consider whether some portion of your wealth should be held in a form that doesn't depend on the system continuing to function exactly as it has. And I'm telling you that the window for making this choice is measurable, not in years, in months. History favors the prepared, and the window for preparation is closing. Thank you for being here today, friends. Stay vigilant.